Hello, everyone. Welcome to the Weekly Watch. I'm your host, John Briggs. I feel like several times this year I've mentioned near historic or historic market moves, but this past week trumps them all. In fact, market volatility has risen to the point where the discussion is as much about market functionality. In other words, are conditions so bad that investors, institutions, and corporations have difficulty managing their risks, as much as the market moves themselves? Certainly, new issuance has dried up to some degree, but this is something more. As an example, short-term forward rates in the US had 80 basis point ranges in a mere few days. And our listeners on the continent certainly know how much volatility injected itself into European sovereign bonds this week, when fragmentation risk drove Italian and other bond yields higher versus German core yields, which they themselves saw historic yield rises. Even in the UK, where the Bank of England hiked by only 25 basis points, and I say only just because others are going by 2 or 3 times that rate, we still saw surging yields in a currency that at one point was close to its COVID-era lows before then reversing. There's so much to unpack here, especially on the ECB side of things, who did try to address fragmentation by saying that they can skew reinvestments to the periphery and they're instructing staff to look at additional measures. So that story is by no means over. But the other major contributor was from the US, where the last CPI report caused yields to surge, not just in the US, but globally, caused a major rally in the US dollar. It sparked a big fall in equities and increased pressure on risk assets in general. This was all accentuated when the Wall Street Journal ran an apparent plant that the Fed would hike by 75 basis points, which they ended up following up on. After this communications mess, guiding to 50 basis points, then leaking 75 through the media, Powell seemed to have not learned from past mistakes and then guided again to 50 or 75 at the next meeting, as opposed to just leaving things open-ended. This made yields fall on the Fed meeting day, but similar to what we saw in the UK with the currency, they were reversing again within just hours. So here I'm going to bring in Kevin Cummins, our chief US economist. Kevin, why did Powell feel the need to try to overguide us in such uncertain times?
Yeah, well, I mean, he tried to justify it yesterday by saying that they need to see compelling evidence that inflation is slowing. Obviously, they're well past their 2% inflation target. It was a bit of a surprise that they would wait, until 2 days prior to the meeting that they would leak it through the journal. He seems like he wants to get this at least to neutral as fast as they possibly can. He made the case that it wasn't worth waiting another 6 weeks and telegraphing that they're going to step up the pace to 75 at the July meeting if they can go ahead and plant it, even though the timing was pretty close to obviously the Fed meeting, just 2 days to go.
So regarding that next meeting, what do you think, 50 or 75?
Yeah, well, he, if you look at the projections on inflation, obviously the focus of the entire press conference was on inflation. You saw that kind of what we thought heading into the meeting, that it was difficult to justify it because of the stepped up pace to 75, because Friday's CPI report wasn't that shocking. I mean, from the perspective of the core was in line with general expectations going into the report. It's just that the headline, we saw a bigger increase in food and energy prices. So he really hung his hat on headline inflation and put all the focus on headline inflation. And if you look at the governors and the president's summary of economic projections, they only moved up their core inflation forecast this year 0.2 from 4.1 to 4.3. It's really difficult to be any higher than that. Realistically, if those forecasts are going to come to fruition, you're going to have, if they wanted to try and point to core inflation as the reason why they were going, at a faster pace here at 75 basis points, they just weren't going to have enough ammunition to hang their hat on that. So he really needed to focus on headline inflation. And that obviously plays well with the American public, that, everybody's paying higher gasoline prices, going out to eat is more expensive, going to supermarkets more expensive. So I think, the fact that back in March when they had their estimates, since then oil prices are up almost $30 a barrel, and they moved their overall inflation forecast up 0.9 percentage points. So that allowed him cover to really emphasize the importance of headline inflation. And that also jived very well with the CPI report on Friday that the headline was 3 to 4 tenths higher than expectations. So that allowed him to really hone in on it and talk to the American public and saying, we hear you and we're doing everything we possibly can. So long story short, I think there's not going to be any sort of reprieve or relief from that perspective this time at the July meeting as well. Energy prices are up significantly over the past course of the month. Food prices are continuing to climb, and the core remains firm. So, that the headline now, it is just a forecast because we're not even through the entire month of June. So we'll get some more data that go into the forecast, but our preliminary forecast for headline CPI is 1.2%. So even stronger than it was in May. And as a result of that, the year-on-year pace will go up to even further, up to 8.9% from 8.2%. So he'll have certainly the cover if everything is looking at the CPI. They'll have cover to go again at 75 basis points and get back to that neutral rate where they think that they need to be in an expeditious manner. They want to get to neutral rather quickly in the face of this robust demand of the economy and an unbalanced labor market. So I think they're going to, have that opportunity to get there pretty quick at July. So I think 75 basis points is something has to. I guess, anything is possible. And he mentioned that 50 or 75 would be something that the Fed would be considering at the meeting. I think it's almost a slam dunk at this point. If you look at the inflation data, that we will see. He also talked about inflation expectations in the Michigan survey. I wouldn't be shocked if those jumped by 0.3 of a point from 3 in May to 3.3 in June. Often enough, we see those Michigan expectations numbers bounce around. That often the preliminary estimate does get revised down later in the month, so it may not be as dire. There'll be probably some talk in the market if we do see those come off a little bit, potentially, that maybe they're only going to go 50. But I think they want to see convincing evidence that the month-to-month prints are slowing before they can feel like they could start to dial it back. And for right now, until they're while they're below neutral, I think 75 is a pretty easy call at this point in time.
Okay. So on the flip side of the coin, on the growth side, with more aggressive Fed action, market volatility, stocks are going down, data's been a little bit creaky, let's say, in the last week. How worried are you about a recession in the US or a very fast slowdown, so to speak?
Yeah, I mean, I think in relative today versus yesterday, the odds of a recession certainly have to go up, with the Fed going, 150 basis points above where they were just 3 months ago. So now, you're not only, as of March, you are at a still accommodative below neutral level of 1.875 estimate for year end. And now you're all the way up to 3 3/8, 3.375%. That will meaningfully slow growth. So, as you mentioned, the data have started to slow a little bit. Yesterday's retail sales, in the wake of that, we clipped our GDP number for Q2. It's probably artificially high because you have some of the unreliable month or quarter to quarter swings and things like trade and inventories, which are both a big contribution in the second quarter in our forecast. But, so the headline is probably misleading at 4%. The overall economy does still seem to be holding up in the fact that it's still growing currently. We had some weaker housing data today. Jobless claims have moved up a little bit, so they'll be a key indicator going forward if we do start to see weaker demand on the labor market. But the Fed seems pretty bent on making sure that inflation gets under control, and it's willing to, slow the economy. I mean, the fact that you're shifting rates up 150 basis points more this year, and potentially jeopardizing the recovery. And Powell really almost acknowledging that inflation is the big key here, and they're not going to stop hiking until they get inflation lower, especially on a month-to-month print. That they potentially could go too much, and we could see a downturn. The one caveat that I would say, though, that makes it a little bit different this time around relative to earlier times when the Fed has over tightened, is that there's this excess savings that was built up during the pandemic, and there is quite a bit of runway left for the consumer. It's just, will the consumer be willing enough to continue to run down those balances and offset the slowdown in the overall economy to keep the economy at bay? And it's hard to say because we have no previous history that we can point to see that sort of reaction. But it certainly increases the odds that you could start to see even slower growth. Now, we did mark our forecast down after that retail sales report to 1.6%. So it possibly could see a little bit of a softening in the labor market going forward as well. And the Fed, consistent with that, also marked their numbers down. And it does show that the labor market, they have ticking up on the unemployment rate out in future years. So, time will tell, but I think we are potentially still in a little bit different of a scenario relative to history, where the Fed overdoes it and the economy crashes, that we have this massive pile of cash sitting on the sidelines, allowing people to continue to run that down. Whether or not they do or not, that potentially could be a different story.
Yeah, and I think that's an important question, whether they do it or not in the face of all these higher cost shocks, or they just keep that savings in the bank. Really going to be important. All right. Well, thanks, Kevin. That's it, everyone, for this week. Next week, the central bank calendar lightens up, but on the data front, we have preliminary June PMI data across the globe, some European IP data, German unemployment data, and perhaps most importantly, on the heels of this Bank of England hike of 25 basis points, which the market seems to be voting as not enough, UK CPI. And as for the markets in general, I would just say stay strapped in. None of this feels like it's over. So thank you. If you like today's episode, don't forget to hit subscribe so you can listen to the latest episodes as soon as they're available. We'll speak to everyone again next week. Thank you.